Good afternoon, everyone. My name is Brian Overby. I'm the Senior Options Strategist with Options Play, and welcome to our presentation on earnings season. I am going to use some of the tools inside the platform, inside the Options Wizard, to help pick strategies on stocks that you might want to trade around earnings season. But before we get too far along, I always have to let you know that options involve risk. They're not suitable for all investors. If you're going to trade options, you should read the characteristics and risks of standardized options. It's all over the First Trade website. If you'd like to receive a copy, if you'd like a hard copy, you can ask them for it and they'd be happy to provide it. We're going to be looking at real trades today, real options. The market's open, it's rocking and rolling. They're not meant to be recommendations. Past performance is not a guarantee of future results. All right, so my name is Brian Overby. As I said, I'm the Senior Options Strategist at Options Play. You can follow me on X. It's at Brian Overby, and my book that I wrote is called The Options Playbook. Now, I'm going to run into the First Trade platform. Let's get busy here. And, the first couple of things that I want to talk about, and we might end up actually going back to the slides, is if I'm trading around earnings, I want to realize that it's going to be a volatile time. I usually don't like to buy options outright, but then again, if you want, that's the one trade that you can do. If if you're looking to, hit a home run on a trade, but it's very hard to trade around earnings because you're trading implied volatility as much as you are trading the actual movement of the underlying stock. And the best scenario, and you've probably heard this before, but the best example of this is you're trying to buy homeowners insurance when the hurricane has already been announced and it's coming towards your home. That is a little bit exaggerated, but that's always the way you kind of think of it, is that the market makers know that there's more likely that the stock is going to move in either direction. It doesn't necessarily mean it's going up or down, but it might actually, that is going to move more than it usually does because of this report that's called earnings. And so if I'm trading around earnings, one of the things that I'm always thinking of is how am I going to battle the implied volatility fluctuation inside the option contracts. And you can be right on direction and still lose because you got your forecast on implied volatility wrong. So buying out of the money calls, buying out of the money puts routinely on options that are announcing earnings is probably one of the hardest things to do consistently and make money. And it's mainly because not only do you have to be right, you have to be really right about the direction. And now here's the good news about it is, if you are right and the stock moves more than expected, then you get rewarded real quick too. Because if you buy out of the money options and you're right, they're cheap. They're cheap for a reason. And usually you can get paid very quickly if you are correct. Okay, so I don't like to play that game. If we're looking at trying to buy options around a known event, there are... most of the time I want to buy an option contract and I want to sell an option contract against it. Now, I've had a lot of people that have came out and said, we would like to, I like to sell covered calls around earnings. And to me, that is counterintuitive in that if I sell a covered call, you're assuming basically that the marketplace has gotten the implied volatility wrong. So you're saying to yourself, I own Google. They're going to be announcing earnings here within the next couple of weeks, or Alphabet, or Apple. Apple is a good one because it's probably one of the most held underlyings just in most retail customers' portfolios. So you're saying, well, there's going to be a pumped up implied volatility. I have 100 shares of Apple. I look at that premium and I'm like, gosh, I would really like to receive that premium for selling a call against my 100 shares. and you think, well, that looks too good to be true, and it usually is. And here's the thing: you're saying that if I sell that call option, the marketplace has the implied volatility wrong. It's pumped up because of this known event, but they're pumping it up too much. There's too much premium in the option. And then on the downside, though, you still own the stock. So you sell that premium, you have limited and known upside, but you still have all the risk of owning the stock to the downside. So I don't necessarily like covered calls around earnings. And I don't mind it if you don't mind getting rid of the stock. There's always a scenario in options where you can, take the other side of the coin. But if I'm just selling calls on positions, that's the one time I don't like to do that I don't like to sell covered calls. Okay, so how would I want to approach it? Well, I'm going to look at Goldman Sachs, and I talked about Goldman Sachs. If you joined me, I filled in for Tony on his market update for the week, and a lot of times I kind of turn it into an option strategy thing, and we're talking around earnings. And so one of the underlyings that we were looking at was Goldman Sachs. So I'm going to pull up the options wizard on Goldman Sachs. And if I'm looking at earnings, as opposed to the covered call scenario, where you have limited and known upside, so if the market blows away the numbers, you limit yourself to the premium plus the potential gain on the upside. And then you still have all the downside risk. Well, I always want to flip the script. If I'm going to take that risk of that earnings report, if I'm going to take that risk, then I want to get rewarded for it. So if I'm leaning into earnings, the probably the most popular strategy that we would promote at Options Play around earnings is a bull call spread, or a bull or a bear put spread, something where we're buying one option contract and then selling an option contract against that position, giving yourself a lot of upside, taking the advantage that there is some pumped up implied volatility so that you can sell an option contract and get something for it, but understanding that it's still a risky scenario and looking into the trade that way. Now, recently, so this morning, so far the banks haven't been doing well. The financials just in general. JP Morgan announced earnings on Tuesday morning. They beat on the bottom line, lost on the top line, meaning revenues weren't as robust as anticipated, but the stock really didn't go anywhere after the earnings announcement. But recently we've seen some weakness just across all financials because of what's happening in Washington. A lot to do with the credit cards and with a lot of I don't know, just speculation on what may happen going forward. JP Morgan actually had a big win with Apple and their credit card, and that news actually drove the stock higher. And if we actually look at the chart here, this was part of the reason to the move to the upside. Now we have the earnings announcement, and we are kind of in a little bit of a gray area. Let me pull this up a little tighter. Let's go and zoom in. Let's look at a 3-month range. And let's put in some support and resistance lines. Okay, so so with this big candle was the downturn. This was after earnings, but after the earnings announcement, the marketplace didn't take the earnings bad. But then we had the headline news about the 10% cap on credit cards, which the marketplace really doesn't, well, I should say most of the analysts don't think it's feasible. It would really stop credit card lending, yada, yada, yada. But bottom line is there's still a lot of speculation. Underlying went down. Now, the biggest gainer in this space has been investment banking. And investment banking in the financial space is loosening up. And there are a lot of deals that are getting done, and JP Morgan is a benefit of that. And we saw that this morning because we had Citibank come out and announce earnings, and they had a really good quarter. Market is down once again in Citigroup, and it has a lot once again to do with the credit card area and all that other news. But as far as Citigroup's investments, I actually highlighted something in the report, and I'm going to just read it aloud here. This is from Reuters that I read this, but here it is. Investment banking fees surged 35% year over year. And that's the area that I think we want to focus on. So ultimately, in the financial space, I think this is a buying opportunity. I think that this will flush out. The 10% is really not feasible. You know, I don't know if I can say that word, right? I am not an analyst that's in that space, but that would be really hard. And I think if anything, that's a negotiating tactic to start with to see have been some other caps, but much higher, 30, 40, just 30% or so interest rates. Like those have been bills that have been not stymied the marketplace. So there you are. I see this as a buying opportunity. We're still seeing the investment banking fees surge. The companies that Citigroup has been one of them that has benefited from it, JP Morgan, Goldman Sachs, but all of these charts are fairly close. They're all fairly similar. So let's go back and look at, that's JP Morgan. Let's see what's going on with Citigroup. C is the symbol. And then I'm going to look at a trade in Goldman Sachs. So we had that same type of movement. I have the support and resistance. Here's the big down candle. Here's the 20-day moving average. You would hope that you would get a little bit of a bounce down around this area. And then we got the 200-day moving average all the way down here. But very strong move to the upside. Earnings announcement, now we're down. Right about 104 is an interesting area, but definitely look at, if we get down to 109, a potential buying opportunity right there. Okay. Goldman Sachs, let's look at the same thing. Now they're announcing in the morning, and not quite as beat up on a percentage basis. 12 points is a lot, but it's a $900 stock. Stock is bounced down. We're sitting right at this level, right at this resistance level right here, heading into that earnings report. All right, so if I wanted to speculate on Goldman Sachs, we've had a couple of stocks that are down at this point in time. One of the trades that pops up is a vertical call spread, and this kind of the options wizard or the options play platform looks at buying this as a longer term hold, looks at it more of a way of investing, not just speculating around an earnings event. And so I say that because that's where the options play score comes from quite a bit when you look at some of these strategies. So if I modify this trade, I'm going to hit the midpoint. That's going to raise, if we could trade at the midpoint, which in Goldman Sachs you should be fairly close on those spreads. What a lot of times you'll do in these is we'll look to buy a longer term option contract, about 65 days out, real option contract, right? $4,733 if you want to buy that one option contract. and we're going to be selling something around a 20 delta is usually about what it picks. And that's the 1,040 level, and that delta is 0.18. This is the delta column. The bid is $9.70. The midpoint is $10.70. And if we did that, we're saying we're going to sell some premium. We're going to have the speculation of just buying an option outright as opposed to buying the stock. And if we are getting a lot of premium because of the earnings, and we're looking to target the 1,040 level on the upside. Okay, that is more of a longer term outlook, and the way that the way that the platform is going to approach this, saying that we are bullish, which is the 1 month and the 6 month outlook. Price action is a bullish trend. It's tested 192 support level and will release earnings tomorrow morning. Very strong. The marketplace just in general has been really strong. Goldman Sachs obviously is known for their best investment banking. This is one of the stocks that has been a little bit of a darling of the marketplace, or has benefited some of the most from the reduction of regulations in the space. Okay. If I want to trade around earnings, there's two ways that I want to adjust this trade. First of all, if I do want to speculate on the upside movement, I don't mind buying something at the money and selling something a little bit out of the money, making sure it's within a range where the underlying could actually get up to the upper strike. I'm still bullish. You still want to lean into that. But how could I modify this? If I'm doing it around earnings, I'm already getting the pumped up implied volatility. I'm still getting a lot of juice from selling this option contract. So I like to go a little bit shorter term. I would focus mainly on around 30 days, and I don't even mind going as low as 16 days if you want to make it more about earnings. But if I do that, I'm going to adjust the strikes. If I'm focusing on a little bit of a longer term, and I know that I'm going to get that decrease in implied volatility, I like to go out about 30 days. All right, and then we're going to modify this because we still want to stick around the at the money strikes. We got the 920, that's a 50 delta. I don't mind buying the 920, going a little bit in the money, about 6 points in the money. And then we're still going to focus on something around, and the 1,000 level is actually kind of an interesting level in Goldman. And we can still bring in $7. So now we cut the time in half, and the price of the option contract really didn't go down that much. And so let me talk a little bit about that. Why was this? I think the other option contract was right around $10.50. About one standard deviation, looking at about a 20 delta. Once again, right around that one standard deviation move. And we're still bringing in real good money, $9.23. Obviously, we don't have quite as much upside on it, but on a relative basis for the time frame, you're still have about the same probability of reaching that strike. And that's mainly because you have higher implied volatility in the shorter months than in the longer months. So there's always a skewing of volatility over the space, over the strikes. So shorter term can be affected more by that hurricane, by that major news announcement. So that's part of the reason why I like to look at these trades and look at a little bit shorter term when I'm trading them around earnings. I'm still longer term bullish on Goldman, and 30 days is, you know, a short term trade, but in the options world, it's a decent trade going out in time. And we're getting a score of 109 inside the platform. So if we click on that, you're looking at, the risk reward. We're risking $2,687, but our potential to make on that risk is almost double that. A little less than double that, right? $5,313. Part of the reason why you're getting that score is that you got a decent risk reward. You have a possibility of it reaching that 1,000 level. That is a possibility. So let's go. First of all, let's do 6 months. Yeah, 1,000 is interesting. I'm trying to see if we went all the way back in time, but that's not going to pop up right there. And see if we've hit that 1,000 level years ago. But with that said, here's where we're at. So the higher this number, the 109, which is in the green, which means that the platform thinks that this is a solid trade based off of volatilities, based off the price. But if you start getting higher numbers, what you really get is a real nice risk reward ratio. Let's see if we go a little higher if we hit the 105. No, we're going down a little bit on it. Sometimes that, and you can see that. But it's more so about how much risk do I have for the potential reward on the trade. And if you can double or even sometimes triple it, and there are scenarios in different underlyings where that happens, then you're going to get a higher options play score. So that score is relative to that. All right. If you have any questions, please do open up the Q&A box, and we'll try to address those questions inside the Q&A box. I'm happy to address any questions that you may have. Now, one of my adjustments that I like to do, if I'm really just speculating on earnings, and Goldman Sachs is announcing on a Thursday, that means you got all day Thursday and all day Friday before the Friday expiration. So if you want to truly make this about earnings, you want to focus on time value. All right. If I'm just speculating that we see Citigroup, we see JP Morgan struggle a little bit, maybe we get a little bit of a pop in Goldman Sachs. Maybe they got beaten up. Maybe it's more about what's going on in Washington than the actual earnings report, yada, yada, yada. Okay. My speculation is that Goldman has already been beaten up on that. Maybe we get a little bit of bounce. Let's look at just that pure speculation play. How would I trade it? Still like the bull call spread. I like to straddle the underlying market. So in this instance, we're going to go real short term. Once again, this is not meant to be a recommendation, especially when we're talking about trades where it's 100% about earnings, and you're going to find out very quickly if it was a winner or a loser. The number is going to come down because you're not going to have the same risk reward. You're going to be about 50-50, right in the middle of it. The stock right now is at 926, and let's hope we got 1 point strikes. I don't think we will though. Let's modify this. Yeah, we're at 15 point strike. All right, so the at the money option contract is the 925. If we go 10 points wide, this should trade for about $5. Now, we're a little bit in the money, so it should trade a little bit more than $5. But let's look at this trade. We're going to have about the same risk to the downside as we have reward to the upside. We're going to stay bullish on it. Now, you can get bearish if you want to lean into the bearishness of all the financial stocks that have came since because of the news headlines out of Washington. You can do that if you want to. So you can apply these same outlooks to the bear side. But I'm gonna stay bullish. Okay, so in this instance, we're going to modify this. We're going to buy the 915 strike call. And then we're going to go about equidistance out of the money. I'd like this to be right at 925, but it's not. So that's the real world for you. And then we'll look at the 930 on the upside. And we'll talk about that risk reward. 925, 930. It's only 10 points what? This market keeps moving on me here. 280. Okay, that's too low. Oh, at 929. That's what I did wrong. Okay, I'm sorry. I knew that was too low, but here we go. Now we're at it. Okay. 50-50 bet. It's around $5. At least we're at 927.53 right now, and we're $4.88. This truly takes out the implied volatility. If we go down 5, we lose our 488. If we go up 5, we make our 512, right? We lose our 488. It's truly a 50-50 bet. Will at Goldman Sachs after earnings go up 5, or will Goldman Sachs after earnings go down 5? And if it's somewhere in the middle, it's somewhere in the middle. Odds are fairly high that it's going to move at least $5 in either direction. The expected move at the money option contract, let's take a quick peek at that, which I just screwed up on because I was looking at, is $19. All right, so the marketplace is looking at about a 38-point move in either direction, right? That's what the marketplace is assuming based off of the at-the-money option contract. If we bought the at-the-money call and we bought the at-the-money put. So this move is very possible. Limiting the risk to $500 by doing the trade, you're buying as much time premium as you're selling. So I'm selling almost, let's go back to the trade, let's look at this. I'm selling $15 worth of time premium because that's an out-of-the-money option contract. I'm buying about $5 in intrinsic value and selling about $15 worth of time premium on the option contract that I'm buying. So whenever you get the time premium equal, that means that you are just trading stock price movement. You implied volatilities can come in, time can decay. It's going to help the option contract that you own just as much as time decay is going to, yeah, it's going to hurt the option contract that you own, but it's going to also hurt the option contract that you sold. So it offsets each other when the time premium is aligned, if that makes sense. Probability of profit, Alex. It has a little bit to do with delta. The answer, the question is, what is pop? If I hit trade here, probability of profit. 50%. It's a 50-50 chance in this instance, and that's what pop stands for. But it really, it's very obvious that if I look at this trade and I take, you got a 50-50 chance. It's exactly what it is. You're paying $5, you can lose $5 or you can make $10. 488, we're rounding off here, and that's where it comes in. Okay, so let's go back and then say, well, if you're willing to speculate more, the expected move is 38 points, right? The at-the-money option contract is 19. If you bought the call, you bought the put. That means that the expected move would be about 38 points. So the potential for this thing to move more than 5 points is, the marketplace is expecting it. You can modify this, and if you want to adjust the risk, well, let's go 5 points more down to the 915 and go 5 points more up, 935, and hit trade, $10. So now you have a 20-point widespread. Just want to make sure I got that math right. And you're paying $10. So once again, very close to a 50-50 scenario where I am risking 1,000 to try to make 1,000. Little bit difference here. The market's moving on us, right, as we're doing this. But still, probability of profit is still going to be right around 50%. It's a 50-50 trade. And now you're saying, well, I'm going to risk 1,000 to try to make 1,000. I need a little bit more bigger. I need another 5-point move to the upside, but the expected move is saying it. As a matter of fact, we've already seen a 12-point move today, which is only 1.34% on the underlying stock. But this is one way to adjust the platform. And I like to talk about it a little bit because the platform is saying, you like Goldman Sachs, here is a trade on a more longer term basis that we have a real nice risk reward scenario. And the options play platform then gives you a higher score if you get this solid risk reward scenario where you can make at least double what you're risking and sometimes triple. The more that you can make on a risk reward basis, the higher the score will be, and it'll look on a longer term platform. But sometimes you just want to speculate on the movement after earnings. And if we do that, I like the concept of straddling the marketplace and looking at doing that trade. Now, on the high volatility scenario, and I just talk about things that I see a lot of retail clients will do. We got high implied volatility. I'm going to click on that. If you wanted to lean into the bearishness or the bullishness, I'll stick with calls just to try to keep things simple, looking at doing a net credit on a call scenario. The platform is once again going to go out longer term. It's going to be selling something more at the money and buying something, well, this time it's actually going quite a bit out of the money, mainly because of the underlying. So $24, and we got 60 points here. It's about the third, so 24 on 60 points. Yeah, that's a decent risk reward, which it usually picks that out. Like on a percentage basis of the risk, okay, you got 24 divided by 60. You're bringing in 40% of the premium on the width of the strikes. So you have 60 points of risk, and you're bringing in 40% of that risk by selling the 930, buying the 990. That's decent, and it probably has something to do with the fact that it's announcing earnings, but you're taking on a lot of risk. Okay, so what will a lot of people do in this situation? They like to just go further out of the money and try to sell something that where you can get the benefit of this premium, and it goes all the way back to the covered call scenario, and you get the benefit of the premium received because of the pumped up implied volatility. But you have a lot of risk versus the reward. And I don't like out of the money calls or even iron condors around earnings because of these scenarios. I don't mind it. You just can't adjust it. If you get a gap opening, you either lost everything or you made a little, and that's kind of a scenario that you look at. So a lot of people will go one standard deviation out of the money. Let's do a shorter term trade. Let's go 16 days. Yeah, I don't mind 16 days. You know what? I honestly would do the 9 days. Um, if I'm speculating on the trade, I would probably look at doing a shorter term trade. I want it to expire. Zero DTE is the whole new rage. And I'm just going to talk about a modification to this trade. Okay. So let's go modify this. We're going to go, actually, let's look at this risk reward. 13 delta. Let's pull this in, go 20 delta. 14, and this is 65. I don't like that. All right, I digress. Let's look at about a one standard deviation move out of the money, and let's look at selling that strike. That is going to be around the 16 delta right here. Okay, so here's the one standard deviation move. Here's the 90 delta. This happens about 16% of the time. The stock actually makes one standard deviation move or more. That's at the 980 level. That's going to be more than the expected move. The expected move is, let's call it 40 points. That would put the stock at 966, right? 966. You're looking at 980. So you're usually a one standard deviation move is more than the expected move. We buy this one, and let's just go 10 points. I'm not suggesting that. I'm saying this is a common trade that a lot of people have a tendency to do to try to take advantage of earnings. Okay. Real nice score. Trade cost midpoint. Okay. 120 on this 9-day trade on a 10-point wide spread. So you're pulling in about 10% on a relative basis. The other trade we looked at was you're bringing in 40% of the premium on versus the risk or the width of the strikes. Here you're looking at 120 divided by 10. You're bringing in 12%, which the math is simple, right? We're looking at 12% of the premium. So you have a lot of risk versus the potential reward. But this is a common trade that a lot of people wouldn't mind doing around earnings. Now, I'm going to give you a modification to this. This is a $1.20, and you might have to do it in a couple of different trades, but a modification to this type of strategy is to actually turn it into a butterfly in this scenario. So this gets a little bit advanced, but here's what I'm going to do. I'm going to modify this trade, and this is the only way that I would do this type of trade around earnings. Okay. Let's add a strike. We sold the 980, bought the 990. We're going to sell two of these, and we're going to buy the 75. Still should get this done for a net credit. We'll have about $5 worth of risk. It's going to be a lot less net credit. That's 10 cents. It needs to be more than that. It needs to be 30 or 40 cents. Midpoint 975. All right, well, let's look at the profit and loss graph now. If I'm looking at this trade, 10 cents isn't, this is dealing with real markets, right? 10 cents isn't enough. I'd want to get 30 or 40 cents on the trade. But if I look at this now, I have that same type of risk. If the market does blow through my strikes, I got this max risk, and the max risk in this scenario would be 5 points. I can make it 10 points, but I'm just going to do this, okay? So if the market comes up, you have this hedge in your trade. You add this long spread that is offset by the cost of the short spread. Now, if the market goes down, you receive that net credit. You have 5 points of risk on the trade, but we're not getting enough net credit to offset the fact that we're receiving $1.20 on the other trade. It's the only thing that bothers me here. But this is a modification to a short call spread that kind of makes sense from time to time. It's not working out right now. But let me adjust this trade, okay? So if we did this, our risk is from 985 to 990. It would be $5 on that trade. And let's delete this. And if this is the 985, 990, we trade that. Oh, two of them, okay. But only be one. 80 cents. Okay, so the skip strike should be about 40 cents. Going 5 points wide, you have risk from 985 to 990. That would be a net credit of 80 cents to the account. And that you have 5 points of risk. If we did it this way and we adjusted this trade, this should be 40 cents, but it's not showing me as 40 cents. 980. And we're going to go the 975. We're going to add that one. $975.80, make this 2. Yeah, it's saying the midpoint is 10 cents. I would want to get at least 40 cents for the trade. If I can get 80 cents on the short spread, where you have the risk from 985 to 990, the way that I want to do this trade then is I want to get at least half of that net credit, and then I have my hedge if the market comes in. And the hedge is that at expiration, if it lands within this range, I can actually put this on for a net credit and take it off for a net credit. The maximum I could trade for is $5. And you can highlight, I mean, if you look at the P&L right there, it's saying $5.10. $5 plus the net credit received of 10 cents. So here's the difference. Here's the moral to the story. If I put on a short spread, I can bring in 80 cents according to the midpoint here. Normally I would think this would trade right around 40 cents, but it's not showing me that. So you got to take what it is. But the thing about bringing in that 80 cents, I have 5 points of risk to bring in 80 cents. If the market goes against me, I'm scared. I got to be nervous about it. If I do this skip strike butterfly or this adaptation to the short spread, if the market actually starts going up as expiration approaches, I'm okay with that trade. I do okay if it lands on my short strike. Now, time decay has to happen. It's still going to work against you, but this is a modification to that type of trade, and this is the way that I would trade short spreads around earnings. I'm looking this as an alternative to a short spread, not as an alternative to a butterfly. You can look at the execution of the trade. I'm telling you, it should be 40 cents. It's almost always half. Almost always half when we look at these type of trades. And then is there any underlyings that we would like to look at? Now we have just looking over, taking a peek at the earnings that are coming up. We're going to get the Meg 7 that's going to start next week. We got Netflix that is going to be announcing on a Tuesday. Then we get the following week is when the rest of the Meg 7 start announcing. We have Microsoft on Wednesday the 28th. We have Apple on Thursday the 29th. Amazon is probably right within that range. So if you're speculating on earnings, these are some of the strategies that you can look at doing. Now, I talked about on the review of the market, if you're looking to own some banks or some higher price stocks after the earnings, let the earnings report come out. JP Morgan is a great example. The stock is down after earnings. One of the things that I don't mind doing is after an earnings report, if you like to get long the stock, is look at buying longer term deep in the money option contracts. Now, I would let this week play out because you're still getting some increased implied volatility just in general because of the fact that Goldman's still going to be announcing earnings. And we still got a couple of other banks. BlackRock is announcing earnings. Morgan Stanley is going to be announcing earnings also on Thursday. So we have quite a few banks that are left that are going to add some of the volatility to the marketplace. But if I am looking at this, buy a deep in the money call option. I like these in the banks because volatility isn't horrible in the banks. It's not a Meg 7 stock. It's an expensive stock. But how would I get long JP Morgan if I want to look at modifying this trade? And I talked about this a lot on Monday, so I don't want to go overboard on it. But we're going to look to go deeper in the money and go further out in time. So now that earnings is gone and that hurricane or that big news event is away, vols will start to come in. Look at the 100, this is half a year out, June 18th call, and now I want Delta. I want to buy Delta. So I want to look at something at a strike price that will allow, I'm on the put side of things. How did I hit that? Okay. I was wondering why the deltas were going down. We're going down, so we're going to go down to this strike, 3 to something around an 80 delta. So I don't mind the 270, 265. Yeah, there's 1 point in delta. Let's look at this one, okay? So trading a deep in the money option contract to receive delta, but not have to put up all the money of buying 100 shares of stock. So now this is 100% an alternative to buying stock. I'm going to buy stock. So $308 stock to buy 100 shares is $30,800. If I go in and I look at this option contract, it's $4,725. It's a real option contract. You get high stock price representation. The delta of 80, to me, it's like buying 80 shares of stock, but you have an expiration date, 155 days away. All right, so $4,725 divided by $30,871 means that you're going to put up 15% of the stock price to own something that acts like the underlying stock. You have time premium. You still got to manage the option contract. But could you buy 100 shares of the stock and lose 15%? Yeah, easily. Like that could happen. Over the last couple of days, we've lost 6 or 7%. So the way that I would approach it is you can buy this option contract. If the market ever does come down and actually hits that strike, I want to get out. I don't want to stay in. It's an option. I want to manage my risk. The market continues on up. The delta gets to 1, you buy that option, you sell that option contract and roll to another 80 delta. So you're taking profits as the marketplace moves, and you're adjusting the amount of capital that you have into it. So market goes up, your market cap is going to increase It's going to become a bigger part of your portfolio. You manage it by selling some and rolling into another 6-month option contract with a different delta. Market comes down, it hits your short strike, or it hits your long strike, your strike price, you get out, or you can just say if this gets cut in half. I got 15% risk right now if I just blindly let this thing go all the way to expiration and the stock finishes below 270. If it gets cut in half, well, then I'm looking at about 8% risk. And that's just the way that I like to trade these. This is one way to, after an earnings report, if I want to get long a stock that I like, look at buying deep into money options. They got to be very liquid. They got to be on stocks like JP Morgan, Alphabet, Meg 7 stocks. I don't want to, even like, even stocks that are kind of liquid. You don't. I don't want to trade because bid-ask spreads can be very wide. And I was trying to think of a bank that's kind of liquid but not extremely liquid. But I'll just define it instead of saying it. Well, PNC Bank is one that's announcing on Friday. That would be a stock that would be very hard to go out and buy deep into money options at. The bid-ask spreads would be too high. All right. Any other questions? Any other sectors that we want to look at as we head into the earnings report? And if not, well, that's it for this edition of the earnings season conversation, if you will. My name is Brian Overby. Once again, I am the senior options strategist at Options Play. If you'd like to learn more about what I do, check me out on x.com. It's at Brian Overby. And check out my book. It's called The Options Playbook. All right. Well, thanks for stopping in.